John, if we're going to trade options successfully, we have to look past the stock price and master the Greeks.
You absolutely nailed it, Steve. That's the difference right there between gambling and actually engineering a trade. You know, when you pull up an option chain, it's so easy to just zero in on the bid and the ask. But the real story, the actionable data, that's all in the Greeks columns.
So, for this briefing, we're going to break down the 4 key Greeks that every single trader has to master. We're talking delta, gamma, theta, and vega. And then, we're going to put it all together.
All right, first up is delta. Now, I always think of this as your directional speedometer. It's basically telling you how fast your options price is moving compared to the stock itself. The main idea here is exposure. Delta tells you straight up how much skin you've got in the game for every single dollar the underlying stock moves. It's your immediate dollar-for-dollar risk right there in one number. Okay, take a look at this example on the chain. You see that highlighted contract? It's got a 0.70 delta. So what does that mean? It means for every $1 move up in the stock, this options price is going to go up by 70 cents. And if the stock drops a buck, well, you lose 70 cents. It really is that direct.
Now, let's see how this builds, because this is where it gets interesting. Next up is gamma. So if delta is your speed, just think of gamma as the turbo that kicks in. This is all about acceleration.
See, the thing is, delta isn't static. It's always changing. And gamma, well, gamma measures how much delta changes. It's the rate of acceleration on your position sensitivity to the stock price. This is what creates those really explosive moves everyone's looking for.
Right, and you can see it right there on the chain. Gamma is always highest for the at-the-money options, the ones with a strike price that's right at the current stock price. That's exactly why those contracts can move so violently when the stock price crosses that strike. The turbo effect is literally at maximum power right there.
Okay, now for a Greek that works against the option buyer, theta. I like to call this one the silent thief. It's this constant, kind of invisible drain on your option's value.
To put it simply, every option has an expiration date, right? Well, theta is just the measure of how much value that option loses every single day, just because that expiration date is getting one day closer. Time is literally money here, and theta tells you the price.
Exactly. Look at this theta value here on the screen, negative 0.05. What that really means is this specific contract is losing $5 in value every single day. That's the cost of holding the position. It's like paying rent that you never ever get back. And what's worse, that decay just accelerates like crazy as you get closer to expiration.
And this right here is a critical distinction. For someone buying an option, theta is a constant headwind. It's your enemy. But if you're an options seller, that daily decay suddenly becomes a source of potential income. You're the one collecting the rent that the buyers are paying.
All right, last of the big 4, vega. Now this one isn't about price or time. This is about emotion. I want you to think of it as the market's fear gauge, or its volatility meter. So when the market gets shaky, or there's a lot of uncertainty, implied volatility just spikes. Vega tells you exactly how much your options price is going to jump for every 1% increase in that volatility. Bottom line, more fear means more expensive options.
And this is such a huge trap for new traders. You could be totally right about the direction a stock is going, but if you buy an option when vega is sky high, let's say implied volatility is way above its normal average, you're just massively overpaying. And then a drop in that volatility, what traders call a vol crush, can absolutely destroy your position, even if the stock moves in your favor.
So here's the bottom line. Once you can really read a full option chain and you understand what delta, gamma, theta, and vega are telling you, you stop guessing, you stop chasing prices, and you start trading the math.
The key is to make this your step-by-step process. 1. You open the full chain. 2. You analyze delta to match your directional view. 3. You assess gamma to see if you want that kind of acceleration. 4. You check theta and vega to really understand your daily cost and your volatility risk. And finally, 5. Use all that data to engineer the trade.
So really the question you have to ask yourself every single time you look at a trade is this. Are you just gambling on the stock price? Or are you looking at the data, at the Greeks, and actually engineering a professional trade? The answer to that question makes all the difference.